Hey, Adam Hoeksema here from ProjectionHub, and in this video, I'm going to answer the question that I get asked way too often is how do I value a business that has unreported cash sales? Oftentimes what happens is a seller will not report cash sales on their business tax return, but then when they're trying to sell the business to you, they'll say, well, I know this is what the tax return says, but actually there's some more sales there that aren't showing up. And so the first thing I want to say here is that you should pay your taxes, and the seller should pay their taxes. And just in case the IRS is listening, pay your taxes, okay? But we know that the reality is that this happens. We know that sometimes there are businesses that aren't reporting cash sales, and so that does play a role in how a business is valued. So I want to take this from the perspective of an SBA lender, because a lot of times my clients are working with me to try to help them acquire a business with an SBA loan, right? And so when it comes to the SBA, it's a federal government agency. They're only going to be looking at what is on the tax return, and they're going to value the business based on what's on the tax return, right? In this example, I've got some example data here from a deal that I was working on. And in this particular deal, they had taxable income of $63,000. But again, in this scenario, the seller was saying, well, there's actually some more revenue there that's not getting reported on the tax return. And they were wanting to then hopefully sell the business for $750,000. But what we were able to do is say, well, how's the lender going to look at this? It has to be based on the tax return. So you start with the taxable income of $63,16, and then you can potentially add back some expenses. So we were able to add back rent because the buyer was going to be purchasing the real estate, and so they wouldn't be paying rent. They're going to own the real estate. And the owner's compensation, the current owner was paying themselves $30,000. And so total cash flow available for debt service, and kind of the most optimistic view here, was $109,000. All right. So then what we do is we know we have $109,000 available for debt service. And so we need to back into how much can the business actually afford to pay in terms of loan payments or debt service. And so we looked at kind of two different scenarios here: a $500,000 loan with a 25-year term at 10%, and a $600,000 loan at 25 years at 10%. You can see this is the annual debt service. So these are the monthly payments. You multiply by 12, you get the annual debt service. And then what we're looking for here is what's called the debt service coverage ratio, DSCR. And this number needs to be 1.25 or above, typically is the rule of thumb for an SBA lender. So the way that's calculated is just taking the cash available for debt service and dividing by the annual loan payment amount. What you're getting there, here we're seeing 2.01 in this example. That means there's $2 available of cash flow here for every dollar of debt service. So that's good in this scenario. So what that tells us is that the business can afford to borrow more. They can afford to borrow $600,000. So at $600,000, that debt service coverage ratio gets to 1.67. Now, the reason in this case why we couldn't go to the seller's request of $750,000 is because if we increase that more, what this number would end up getting too close to that 1.25. The lender in this scenario wanted to keep some budget in here for owner's compensation. So they were adding back all of the owner's compensation, but the lender says, the new buyer really should get paid for the work that they're doing, right? So let's not add that back. And when you don't add back in that owner's compensation of $30,000, now you see the debt service coverage ratio is just at the 1.21. So it's really kind of right there on the edge. So in this scenario, we could get a deal done at that $600,000 price point, not the $750,000. Now, if that seller had reported all of their cash sales, they would have had higher taxable income, and that higher taxable income would allow them to cover more debt service. In other words, they'd be able to qualify for a larger SBA loan. So just so you know, as a seller, what you're doing when you're not reporting those cash sales is you are definitely hurting your ability to get a higher sales price at the other end of the process here, right? So again, pay your taxes. But I hope this video has been helpful in kind of thinking through how an SBA lender is going to be looking at this. If you have a deal that you're looking at, I do offer a free SBA review. I'm going to put a link in the description of the video below so you can fill out that form. It'll just tell me a few details about your deal and about your personal financial situation, so I can give some feedback based on my 12 years of experience as an SBA lender. So we'd love to help you with that. Feel free to reach out to us at support@projectionhub.com if you have any questions. Thanks.